Accounting and reporting for healthcare providers is what's covered in this presentation. Healthcare expenditures account for 17.6% of our gross domestic product, much of which is paid by third-party payers. From a financial reporting perspective, these organizations have no need to compute and report net income. However, readers of the financial statements need a way to measure the efficiency of the entity's operations. And this is why the FASB requires the reporting of a performance indicator to show operational success or failure. Now, accounting for patient service revenues. Bad debts and fee reductions for healthcare organizations can be significantly higher than for other kinds of businesses. Amounts that the entity does not intend to collect should not ultimately be reported as revenues. In many cases, the patient is not responsible for the entire bill. Third-party payers, such as insurance providers, are an important part of the process. Now let's take a look at an example. General Hospital is a private not-for-profit hospital. In March, their patient charges totaled $10 million. 60% of these charges are expected to be collected from insurance companies. The remaining amount is due from the patients. So what does the journal entry look like? It would be accounts receivable third-party payers, $6 million, accounts receivable patients, $4 million, and then patient service revenue of $10 million. Now, as you know, we're not going to collect all this, so we're going to have to make certain adjustments. Some of them will affect the amount of revenue recorded, and some of them will increase our expenses associated with generating this revenue. Okay, of the amount due from patients, $2 million is related to services rendered to poor patients that the hospital did not intend to collect. So what we have to do here is we have to back this out of revenue. So now we're down to $8 million, and we have to take the accounts receivable out of the books because we know we're never going to collect it, so we cannot record the revenue nor set up the asset on the books. So again, you cannot report revenue that you never intend to collect. Of the remaining amount due from the patient, General Hospital knows from its history that a percentage of it will not be paid. They record $240,000 as an estimate. So they're going to record bad debt expense of $240,000 and allowance for uncollectible accounts of $240,000. Note that this entry is similar to the way a for-profit enterprise estimates uncollectible accounts. So this is using an allowance method. The hospital also has contracts with many third-party payers, which provide for additional reductions in fees or set fees for specific procedures. These contractual agreements are recorded separately to track the amount the hospital must write off as a result of these agreements. So, of the $6 million that General Hospital has billed the insurance company, it projects that it will collect only $4,400,000 based on contractual agreements. They must write off the difference. So, contractual adjustments is going to be an expense, and allowance for uncollectibles will go against the allowance account. So now, in summary, of that original $10 million that we billed, based on all of these adjustments, their actual estimated receipts are $6,160,000, or for every dollar they bill, they get 62 cents if they're lucky. That concludes the presentation on accounting for non-for-profit healthcare providers.